Most people hear inflation is back to normal and think that means life should feel normal again. Then you open a grocery app, your rent renewal hits your inbox, car insurance jumps, and 3 different subscriptions quietly tick up by $2. The confusing part is that none of this feels like it's reversing, and it makes you wonder if the numbers are fake. The answer is that inflation can look normal on paper, while your life still gets more expensive. Because the index isn't your budget. And because the biggest costs, especially housing and monthly payments, behave differently than the stuff the headline number is most sensitive to. Headline inflation is usually the CPI, the Consumer Price Index, and it's basically a weighted basket of things households buy. It averages across millions of people, so it's not measuring your exact mix of rent, gas, daycare, or commuting. It's also usually reported year over year, which creates a constant misunderstanding. Lower inflation doesn't mean lower prices, it means prices are rising more slowly. Think of inflation as the speed and the price level as the altitude. Slowing down doesn't bring you back down the mountain, it just means you're climbing more slowly. Reason 1 is that the inflation number is an average, and your personal inflation rate can be totally different. If you rent in a hot city, drive a lot, or have kids, your basket is heavier in the categories that have been rising fastest. The index also assumes substitution, meaning if steak gets expensive, you buy chicken, and the cost is treated as contained, even though your choices got worse. In real life, that looks like switching brands, accepting smaller portions, and skipping a couple of nights out because the same routine now costs 50% more. The takeaway is simple. Treat CPI like a weather report, and your budget like what you're wearing today. Reason 2 is housing, which is the boss level because it combines scarcity with financing. In many places, housing supply grows slowly because building is slow, land is limited, and local rules make adding units hard, while demand can move fast with jobs and population. Rents are also sticky because you don't renegotiate every month, so the pain comes in big resets when a lease ends. Higher interest rates can freeze would-be buyers, pushing more people into renting, and that can keep rents up even when other prices cool. And CPI's housing measures, like rent and owner's equivalent rent, can lag what you feel in real time, so the official number can improve after your rent already jumped. Reason 3 is asset inflation and credit, including what people casually call money printing. A more precise way to say it is that when central bank balance sheets expand and credit is easy, a lot of the new money flows into assets first, like stocks and real estate, because that's where large loans and big portfolios concentrate. When asset prices rise, home prices rise, and that pressure eventually shows up in rents and in the buy-in cost of normal adult life. You might not own a rental property, but you can still pay the mortgage of someone who does through rent. The takeaway is that goods inflation can cool, while housing and assets stay elevated because they're driven by different forces. Reason 4 is debt and higher rates, which many people experience as monthly payment inflation. The sticker price might not change much, but as the interest rate jumps, the payment jumps, and your cash flow is what runs your life. That shows up in credit cards, auto loans, student loans, and even insurance premiums that get repriced more often than your salary. A car that cost the same as 2 years ago can be hundreds more per month if the rate is worse, and that difference competes with groceries and rent. The takeaway is to separate price-level inflation from payment inflation, because they hit your bank account on different schedules. Reason 5 is pricing behavior. Prices often go up like rockets and come down like feathers. During supply shocks, companies raise prices fast because their costs are rising and because consumers expect chaos, so they tolerate increases. When costs fall, prices don't always fall the same way, because customers get anchored to the new normal, and because in concentrated markets, there's less pressure to compete prices back down. Some of the price increase is also shrinkflation, where the box stays the same but the ounces drop, and premiumization, where the cheap tier disappears and you're pushed into the nicer, pricier version. The takeaway is that inflation cooling doesn't guarantee a satisfying rollback, especially in categories where you don't have many alternatives. Now add the part that makes this feel personal. Wages usually lag. Your rent and groceries change week to week, but your pay changes on annual review cycles, and switching jobs or negotiating takes time and risk. There's also a visibility problem. You see prices constantly, but you don't feel a raise until it hits the paycheck. And even then, taxes and benefit costs can eat part of it. Here's the math that messes with people. If prices jump 10% in year 1, and then 3% in year 2, your cost level is still about 13% higher than 2 years ago. If your wage rises 4% and then 4%, you're still behind, and that gap feels like the system is lying, even when the headline number is technically improving. A quick myth to kill is the idea that if inflation is down, prices should go back to 2019. That would require broad deflation, meaning prices falling across the economy. And that's rare because it usually comes with job losses or a credit crunch. What happened recently also matters. After the pandemic, supply chains were strained, stimulus and savings boosted demand, and then rate hikes cooled a lot of goods inflation, while shelter measures took longer to roll over. So, what should you watch instead of one headline? A small dashboard works better. Shelter inflation, real wage growth, debt servicing costs, insurance and utilities, food at home versus food away, and local rent indexes where you actually live. If you want a clean mental model, it's this. Inflation normal can coexist with life expensive, because your basket isn't the average. Housing is heavy and slow to adjust. Asset and credit cycles lift big-ticket costs. Higher rates raise monthly payments, and many prices don't fully revert after a shock, all while wages catch up late and unevenly. If you do anything, do it at the level of visibility, not guilt. Track your personal inflation rate in your top 5 categories, because the big lines matter more than the small ones. If a category dominates your budget, it's worth treating it like a negotiation or an optimization problem, whether that's housing, transportation, or interest rates. And remember that small income percentage changes compound in the same way small price increases do. The disconnect you feel is structural, not a personal failure, and once you can name the moving parts, the world gets a little less confusing.